He's the man who lost the most money, the fastest in history. $200 billion in just 2 days. Bill Hwang of Archegos Capital Management. This one man single-handedly caused a massive crash in over 10 Chinese companies listed in the US. He also managed to make 6 major Wall Street investment banks lose billions of dollars. And to top it all off, he lost another $200 billion himself. The most astonishing part? All of this happened in just 48 hours. This guy was something else. You could say he earned the title of the fastest loser in modern financial history. It's practically epic. So, who is this guy? A hedge fund manager most people in finance had never even heard of, who quietly grew his assets from $2 billion to $200 billion. If he had gone any further, he might have become the richest person in the world before anyone even knew his name. Today we're diving into the Bill Hwang saga, dissecting how he managed to lose $200 billion in 2 days and drag half of Wall Street down with him. I even consulted with my Wall Street expert colleagues for this video, so make sure to hit that like button. Bill Hwang was born in South Korea and immigrated to the United States in 1982. He earned his bachelor's degree from UCLA and an MBA from Carnegie Mellon. After graduating, he worked in sales at a securities firm for a few years, where he gradually revealed his extraordinary talent for investing. This caught the attention of the legendary hedge fund tycoon, Julian Robertson, who recruited him to join his firm, Tiger Management. Hwang's performance at Tiger Management was so impressive that Robertson entrusted him with launching his own fund, called Tiger Asia Management. So you see, Bill Hwang was a force to be reckoned with. He lived up to the expectations, successfully growing Tiger Asia Management to a staggering $5 billion in assets under management. However, Bill Hwang couldn't resist playing dirty. In 2012, the Securities and Exchange Commission, SEC, caught him engaging in insider trading. He was slapped with a $44 million fine, and Tiger Asia Management was shut down. As part of the settlement, he was barred from managing outside money until 2020. But Bill Hwang wasn't fazed. He thought, fine, you don't want me to manage other people's money, I'll just play with my own. He decided to set up a family office called Archegos Capital Management using his own $220 million. Over the next 8 years, from 2013 to 2021, Bill Hwang worked his magic once again. With his aggressive investment strategies, he transformed his $220 million into a jaw-dropping $20 billion. Now you must be wondering, how did he do it? Are you ready to join the billion-dollar club? Bill Hwang's investment strategy was surprisingly simple. He essentially inherited the legacy of Tiger Management, fundamental analysis and stock picking. He looked at company performance, financial statements, operations, and of course, some insider information. He bought companies he believed in and shorted those he didn't. He went all in, betting big on a select few companies while also hedging his bets. Initially, Bill Hwang had just been penalized by the SEC, and his $220 million wasn't exactly a small sum, but it wasn't turning heads on Wall Street either. So the big investment banks like Goldman Sachs and JP Morgan Chase steered clear of him. They weren't interested in doing business with him or lending him money. Bill Hwang had to trade on his own, and he couldn't use too much leverage. So whether he won or lost, it didn't really impact the market. But you have to hand it to him, Bill Hwang had an incredible knack for picking stocks. From 2013 onwards, the stocks he chose, Amazon, Facebook, Netflix, they all doubled in value year after year. And Bill Hwang was incredibly patient. He held onto the stocks he believed in, never selling. By 2017, in just 4 short years, he had turned his $220 million into a cool $4 billion. Now, $4 billion, even for Wall Street, is not exactly chump change. And Bill Hwang's overall investment strategy wasn't considered particularly risky. So he was essentially a client with deep pockets who wasn't likely to go bankrupt. Wall Street banks came knocking, eager to lend money to this rising star in the investment world. With the backing of Wall Street, Bill Hwang was able to utilize a financial instrument that allowed him to maximize his leverage. This instrument propelled him into the $10 billion club, turned him into a market mover without anyone realizing it, and ultimately led to his spectacular downfall. Sounds intriguing, right? This instrument is called a total return swap, or TRS for short. So, what exactly is a TRS? Don't let the name intimidate you. The concept is actually quite simple. Let's take Apple as an example. Let's say I have a hunch that Apple's stock is going to go up. If I'm a regular investor, all I can do is buy the stock. Let's say I have $1 million. The most I can do is buy $1 million worth of Apple stock. If Apple goes up by 20%, I make a profit of $200,000. Of course, I could always use leverage. According to US regulations, I can borrow up to 50% of the value of my investment, essentially doubling my leverage. So with my $1 million, I can now buy $2 million worth of Apple stock. If Apple goes up by 20%, I make a profit of $400,000. Sure, there are some borrowing costs involved, but they're insignificant compared to the potential profits. Now, 2 times leverage might seem like a lot to the average person, but for Bill Hwang, who had unwavering confidence in his analysis, it wasn't nearly enough. He wanted more. That's where the TRS comes in. It's essentially a contract that allows you to gain higher leverage by putting up collateral. Let's say Bill Hwang approaches an investment bank, let's say Goldman Sachs. He says, hey, let's make a deal. I bet you that Apple stock will go up by more than 1% in a year. If I'm right, you give me $50,000. If I'm wrong and it goes down by 1% or more, I'll give you $50,000. What do you say? Now, if Apple goes up by 20% like we discussed earlier, Bill Hwang makes a profit of $1 million, but if Apple drops by 20%, he loses his entire $1 million, effectively achieving a leverage of 5 times. As you can see, the risks are significant, but it's not that straightforward. Let's look at it from Goldman Sachs' perspective. They're not going to take on that much risk for a measly $50,000. Wall Street is all about making money with as little risk as possible. Goldman Sachs wants to earn their fees without any risk whatsoever. So, what are the risks that Goldman Sachs faces in this scenario? There are 2 main ones: credit risk and market risk. Credit risk refers to the possibility of Bill Hwang defaulting on his end of the deal. What if he goes bankrupt and can't pay up? Goldman Sachs isn't foolish. They're going to ask for collateral. They might say, sure, we'll take that bet, but we need some security. You don't have to give us the entire $5 million up front, but how about you deposit $1 million as collateral? This way, if Apple were to plummet by 20%, Bill Hwang would either have to provide more collateral, Or Goldman Sachs would sell his collateral to cover their losses. By obtaining collateral, Goldman Sachs effectively mitigates their credit risk. And Bill Hwang, by providing that collateral, gains access to a higher leverage of 5 times. The other risk is market risk, which is the risk associated with fluctuations in the stock price. For example, if Apple actually goes up by 20% in a year, Goldman Sachs would have to pay Bill Hwang $1 million, resulting in a loss for them. That's not a risk they're willing to take. So, to hedge against this market risk, Goldman Sachs would go out and buy $5 million worth of Apple stock in the market. Now, if Apple goes up by 20%, they pay Bill Hwang his $1 million, but their own Apple stock holdings would have also increased in value by $1 million, effectively offsetting their losses. This way, regardless of how Apple stock performs, Goldman Sachs breaks even. So, they've successfully hedged against both market risk and credit risk, but they're not doing this out of the goodness of their hearts. They need to make money, right? Where do they get it from? Bill Hwang, of course. Goldman Sachs would tell him, "We're happy to take this bet, but it's not free. You'll have to pay us a service fee, let's say $50,000. Now, Goldman Sachs has a foolproof plan. No matter what happens, they make a cool $50,000 in service fees. From Bill Hwang's perspective, while he has to pay a fee, he gets to enjoy a leverage of 5 times. If his analysis is accurate, becoming the richest person in the world is within reach. Moreover, the TRS offers Bill Hwang a hidden advantage. He doesn't have to buy the stocks himself. Remember in our example who actually bought the Apple stock? It was Goldman Sachs, the investment bank. Even if Bill Hwang becomes one of the biggest players in the market, no one would know. However, this very secrecy surrounding TRSs would come back to bite the banks. With the floodgates open, Bill Hwang proceeded to engage in TRS trades with 6 different Wall Street investment banks. He leveraged up and made massive bets on a range of US media companies and Chinese stocks, including Viacom, Discovery, Farfetch, VIP.com, and more. While we don't know the exact extent of Bill Hwang's TRS trades with these banks, we can see that starting from the second quarter of 2020, these banks began heavily investing in the same stocks that Bill Hwang was bullish on. For instance, in the second half of 2020, Morgan Stanley purchased 40 million shares of VIP.com. It is believed that this was driven by Bill Hwang's TRS trades. In just 2020 alone, these banks earned hundreds of millions of dollars in service fees from Bill Hwang. And Bill Hwang, he was raking it in. From the fourth quarter of 2020 to the first quarter of 2021, the stocks he had bet heavily on soared by over 40%. That's tens of billions of dollars in profit. It was a match made in heaven. Little did these Wall Street giants know they had fallen for a player. Bill Hwang wasn't just involved with one bank. He was juggling relationships with 6: Goldman Sachs, Morgan Stanley, Nomura, Credit Suisse, Deutsche Bank, and UBS. He was playing the field. And because of the inherent secrecy of TRS transactions, none of these banks were aware of the enormous risk they were all facing collectively. By March 2021, these 6 banks were holding a combined total of $1 trillion worth of positions on behalf of Bill Hwang. One particular stock, Viacom CBS, accounted for a whopping $10 billion of Bill Hwang's portfolio. He was likely the single largest shareholder in the company, and Viacom CBS had been a star performer, tripling in value over the previous 3 months, making it the biggest contributor to Bill Hwang's overall gains. But as we all know, a player's game always ends the same way: heartbreak and disaster. It's only a matter of time. On Monday, March 22, 2021, Viacom CBS announced a $3 billion stock offering. On Tuesday, the stock tumbled by almost 10%. Remember how Bill Hwang had used TRS trades to leverage himself up 5 times and amass a $10 billion position in Viacom CBS? Well, as the stock price plunged, the investment banks started getting nervous. Their risk managers, those responsible for keeping an eye on potential losses, urged Bill Hwang to cut his losses and unwind some of his positions. But Bill Hwang refused. As we discussed earlier, when Viacom CBS's stock price plummeted, Bill Hwang was required to provide more collateral or margin to cover his losses. He tried to free up cash by selling off some of his other holdings, but the market was relentless, giving him no breathing room. On Wednesday, Viacom CBS plunged another 20%. At this point, Bill Hwang had run out of collateral. He had nothing left to offer. What happened next? Now, things are about to get interesting. Are you ready for this? Let's analyze the predicament that both Bill Hwang and the investment banks found themselves in. For Bill Hwang, if Viacom CBS continued its downward spiral, he was finished. Bankruptcy was inevitable. However, if Viacom CBS rebounded, he would escape unscathed. But for the banks, it was a different story. Remember how they had hedged against market risk? They didn't care whether Viacom CBS went up or down. Their primary concern was Bill Hwang's potential default. If he went bankrupt, they would be left with massive losses. In other words, if Viacom CBS continued to tank, the banks would incur substantial losses. Now, investment banks are rational entities. They realized that at this point, their involvement with Bill Hwang had become a losing proposition. They couldn't afford to pin all their hopes on Viacom CBS staging a miraculous comeback. So, the best course of action for the banks was to cut their losses and exit their positions as quickly as possible. The moment the banks decided to pull the plug, it sealed Bill Hwang's fate. They would be forced to sell off all the stock positions they held on his behalf, causing the stock prices to plummet further and ultimately leading to his demise. But here's where things took an even wilder turn. As the banks scrambled to unwind their positions, they made a startling discovery. Bill Hwang had been playing them all along. He had secured identical deals with 6 different banks. What did this mean? It meant that if Bill Hwang went bankrupt, each of these banks would suddenly find themselves holding billions of dollars worth of unwanted stock positions. They would all be forced to sell off these shares simultaneously, sending the stock prices into a freefall. They would be selling into a collapsing market, guaranteeing catastrophic losses. At this point, it was no longer a game between the banks and Bill Hwang. He was already finished. This had become a high-stakes game of chicken among the banks themselves. Let's break down the delicate dynamics at play. Since they all needed to sell, if the 6 banks could somehow manage to stay calm, hold their nerve, and sell gradually, the stock prices would decline, but the overall losses would be minimized. This was the collective best case scenario. So naturally, the 6 banks arranged an emergency meeting on Thursday to discuss how they could discreetly and with minimal market impact unload these massive stock positions. But as you might have guessed, the talks collapsed. Why? Because in such a situation, each bank faced a classic prisoner's dilemma. They had two options: either cooperate and sell slowly, or betray the others and dump their shares as quickly as possible. If the other banks chose to cooperate and sell gradually, and a bank also chose to cooperate, they would incur some losses, but they would be manageable. However, if they betrayed the others and dumped their shares while everyone else was cooperating, they could potentially minimize their own losses at the expense of others. On the other hand, if everyone else decided to betray and sell rapidly, and a bank chose to cooperate and sell slowly, they would be left holding the bag, facing devastating losses as the stock prices cratered. But if they also chose to betray and sell rapidly, they would still incur losses, but they would be less severe than if they had cooperated. So, even though the collective best case scenario was for all 6 banks to cooperate and sell slowly, from an individual bank's perspective, regardless of what the others did, the most rational choice was to betray and sell rapidly. It was a classic prisoner's dilemma. In such a scenario, reaching an agreement was next to impossible. And so, as you might expect, the 6 banks did what rational actors do in a prisoner's dilemma. They all chose to betray. And so, on Thursday afternoon, March 25th, Morgan Stanley was the first to break rank, quietly offloading $5 billion worth of stocks to their hedge fund clients at a discount. Before the market opened on Friday, Goldman Sachs followed suit, selling off $6.6 billion worth of shares. And then another $3.9 billion after the market opened. The race was on. The banks were frantically making calls, desperately searching for anyone willing to buy their unwanted shares. It was a fire sale of epic proportions. This is why, seemingly out of nowhere, the stock prices of those Chinese companies and US media companies that Bill Hwang had bet so heavily on began to plummet. Within a week, Bill Hwang was wiped out. His $20 billion fortune vanished into thin air. As for the banks, Nomura reportedly lost $2 billion, while Credit Suisse emerged as the biggest loser, with a staggering $4.7 billion hole in its balance sheet. Goldman Sachs and Morgan Stanley, the first to react and offload their shares, escaped with relatively minor losses. So, as you can see, things are not always what they seem. What appeared to be a simple case of a wealthy investor making a bad bet and blowing up turned out to be a cautionary tale of regulatory oversights, Wall Street greed, and the perils of the prisoner's dilemma. In the stock market, there are only buyers and sellers, prices going up and down. But behind these seemingly random fluctuations lies a complex web of competing interests and cutthroat competition. Perhaps that's what makes the stock market so captivating and unpredictable.